Chapter 2, Transaction Analysis. The learning objectives for this chapter are: number 1, recognize a business transaction and the various types of accounts in which it can be recorded. Number 2, analyze the impact of business transactions on the accounting equation. Number 3, analyze the impact of business transactions on accounts. Number 4, journalize transactions and post journal entries to the ledger. Number 5, construct a trial balance. Okay, so learning objective number 1, recognize a business transaction and the various types of accounts in which it can be recorded. A transaction is any event that has a financial impact on the business and can be measured reliably. It provides the objective information about the financial impact on an exchange. So one gives something up and then one also receives something. Every transaction has something that is given up and then something is being received. As an example, if you go down to Best Buy and you want to buy a computer, well, you purchase a computer, you walk away with a computer, but you also had to give up cash. Or if you sell something, let's say you have a computer that you're giving to a friend, do you want to buy this computer? You tell your friend says yes, you sell the computer to the friend, you gave up that computer, that's something that you give up, and then you receive cash. So accounting records those economic events. And then accounting also records both sides of the transaction. Accounting records what you're giving up, and it also records what you're receiving. So when we're talking about a transaction, it always has at least, at a minimum, 2 accounts that are impacted by any one transaction. The accounting equation is expressed as the following: assets equal liabilities plus stockholders' equity. Assets equal liabilities plus stockholders' equities. Now, we've already talked about defining what an asset is. An asset is something that has future value. A liability is a future obligation. And stockholders' equity, or equity, is the difference between assets and liabilities, whatever the difference is between the assets and liabilities. And also, it is the ownership claim against the assets. Defining a specific account, we have account is like a record of all changes in a particular asset, liability, stockholders' equity during a period of time. So if you have assets, then you categorize each asset into its own account. For example, cash is an asset, so it carries its own account called cash. Accounts receivable is an asset. It carries its own account. Inventory, that is an asset. It has its own account. Liabilities have their own accounts as well. So the liabilities, the example would be accounts payable, notes payable, mortgage payable, salaries payable, income tax payable. Seems like most liabilities have payable at the end, so that gives you kind of a clue as to if you see payable at the end of an account, it's almost certainly going to be a liability. And stockholders' equity, that's a little bit tricky. It's not as clear, but there are specific accounts that you will commonly see, especially for stockholders' equity, meaning a corporation. You'll have common stock, you'll have retained earnings. And then what makes up retained earnings under the stockholders' equity section includes revenues. So anything that you've sold, the revenue accounts that you have will be under the stockholders' equity section. And then any expenses that are incurred, those will also be tracked under the stockholders' equity section. The next slide goes on to highlight exactly what I just said. You have assets, including cash, AR, inventory. Adding to that, prepaid expenses. Those are expenses paid in advance, such as insurance or rent. You may have investments, and you may have property, plant, and equipment. So those are all examples of assets. Examples of liabilities, the definition is a debt or payable. The way I described it to you is a future obligation. Example specific accounts that are liabilities include accounts payable, notes payable, and accrued liabilities. Accounts payable is a promise to pay a debt, and notes payable is a promise to pay a note in the future. And accrued liabilities are liabilities for an expense that you have not yet paid. So something that you owe that you have not yet paid. As an example, salaries payable. You might include salaries payable under accrued liabilities. So accrued liabilities is kind of like a catch-all. It's often made up of a lot of different payables or amounts due that you have listed on your balance sheet that you just don't identify them specifically, like accounts payable, like notes payable. Stockholders' equity section, the claims. The stockholders claim, and when we see stockholders, we mean owners. The stockholders claim to the asset. You have common stock, which is the owner's investment in the corporation through stock. Retained earnings, cumulative net income minus net losses and dividends over the company's life, and then dividends. Retained earnings is really sales minus your expenses and the corresponding net income or loss. But it's accumulated over time. Now, it's what you retain. So if you pay it out in dividends, it goes away. It leaves the corporation. It leaves the company. And dividends, that's a distribution of the company's earnings to its shareholders. It's a reward to the shareholders for their investment. Kind of like if you think of when you borrow money, you pay interest. That's the interest is the reward to the lender. Well, the dividends are very similar to interest, except we call it dividends because technically the shareholder is not loaning the company money. The shareholder is investing his or her money. And so therefore, many investors expect or want to receive a dividend as a reward. Stockholders' equity section includes revenues, which I've already mentioned to you. That is, revenues are going to be increasing stockholders' equity because that's the sale of those revenues. Think of revenues as a good thing, that sales are a good thing for the ownership. Expenses, I hate to say bad thing, but they certainly decrease stockholders' equity due to the cost of the operating the expenses. So they're necessary because you can't generate revenues without having some expenses. From the shareholder's perspective, we certainly want to maximize revenues and minimize expenses, which will result in the highest net income. And the income for the company is there available to do one of two things. It can either retain it, retained earnings, so that it can use that money to then turn around and try to invest in its own future, or it can pay that money out as dividends to shareholders as a reward.